Now, sometimes back when I was going through sources of business finances, I told you guys that organizations raise finances. I did inform you that organizations raise finances through various ways. We went through the various sources of business finance. And if you can remember, the long-term finance, the long-term sources of finance, there are a number of sources that we talked about, like the issue of ordinary shares, the issue of preference shares, the issue of debentures, and so forth and so on, utilizing retained earnings. When organizations obtain capital from whichever source, whether it's short-term, medium, or a long-term source, the money is not for free. The money that organizations obtain for various sources is not money given for free. There are costs associated with money that an organization borrows. There are costs associated with funds which organizations borrow. Is it difficult to mute yourself? Now, please let me tell you, I'm unwell and I don't want to start getting pressure. Eh? Kindly, I'm unwell and I don't want to start getting pressure. Mute yourself. We don't want to hear that noise from that background. So this capital that an organization goes for, whether it is from the short-term or medium-term or long-term sources, the money is not for free. Organizations cannot be given money for free. There are cost implications. There are costs that arise therefrom. These costs are the ones which we call the cost of capital. Yeah, whatever capital that the company goes for to finance the operations, whether from the short-term or medium-term or long-term sources, we know that organizations raise money from various sources, and that money that organizations raise from various sources is not for free. There are cost implications. So cost of capital are basically financing costs which organizations, those are financing costs which organizations incur on money that an organization will obtain to finance their assets. Borrowing of funds from whichever source leads to incurring of financing costs. These financing costs are the ones which we call the cost of capital. It is cost on that capital that an organization goes for, whether through the issue of ordinary shares or through the issue of debentures or through another source. But because organizations raise capital from many sources, we shall not explore the cost of capital of all the sources of funds. We shall not be able to go through the cost of capital of all the sources, whether short-term, medium, and the long-term. We shall focus on a few elements. Now, cost of capital is cost from the company's point of view, but it's a return from the investor's perspective. So cost of capital, we're looking at it as a cost from the company's point of view. But that cost to the company is a return to the investor. Like if a company were to issue debentures, for example, raise capital, then the company incurs interest. That interest cost is a return to the investor. If a firm were to issue ordinary shares to raise capital, then the firm will have to appropriate earnings in the form of dividends to the shareholders. That dividend is a financing cost to the company, but is a return to the investor. The same thing applies to preference dividend. That preference dividend is a financing cost to the company, but a return to the investor. And that's why in these notes which I shared with you, I think I was very, very clear here. And I said cost of capital is defined as the minimum required rate of return by the providers of long-term capital. That is ordinary shareholders, preference shareholders, and debenture holders. We are going to revolve our discussion around this. We're going to revolve our discussion around these three long-term forms of capital: ordinary share capital, preference share capital, and debenture capital. So when we begin looking at the cost of capital, in this case, we are going to restrict ourselves to those three because those three are very, very important. Those three are long-term forms of capital. So debenture capital, preference share capital, and preference share capital, debenture capital, and the ordinary share capital are very, very important long-term forms of capital. They're very important long-term forms of capital. So when we look at the cost of capital, in this case, we are going to revolve ourselves, or rather revolve around establishing the cost of debenture capital, the cost of preference share capital, and the cost of equity capital. Those three elements, they're very, very important long-term forms of capital. I've already said that what we call cost of capital from the investor's point of view is basically a return from the investor's perspective. The cost of capital is also at times known as opportunity cost of capital. Now, why do we worry about cost of capital? Why do we have to be concerned with the computation of cost of capital? Let me say that the cost of capital are certain practical applications in business. There are certain main practical applications in business. And for that reason, firms have to determine their cost of capital with care. Firms must determine their cost of capital with care because cost of capital has certain practical applications in business. If an organization does not determine its cost of capital, then an organization will end up making decisions which are not correct. Sometimes we like using the word making non-optimal decisions. A company could make decisions which are non-optimal. And such decisions which are non-optimal could hinder from attaining their main objectives. You remember we talked about certain main objectives that value maximization and so forth and so on. So could a company be able to attain the main financial objectives like those ones? Maybe maximizing profit, maximizing value, and so forth and so on. It's important that organizations make decisions that are good. Failure to determine the cost of capital could hinder a firm from attaining their main objectives. It could hinder a firm from attaining their main objectives, like the value maximization objective, which is one of the main objectives that firms strive to achieve. Now, there are certain practical applications of the cost of capital. Capital investment appraisal. When you are going through capital budgeting, you remember when you're computing the net present value of a project, computing the internal rate of returns, you can remember what we were using as a discounting rate was cost of capital. Therefore, if a company does not determine their cost of capital with care, then it could end up making decisions which are not correct. So one of the main applications is capital investment appraisal. The other application is valuation of financial securities. If you check the handout which I've shared with you, section 3 class, you realize that one of the applications of the cost of debt, the cost of preference share capital, the cost of ordinary share capital is valuation of ordinary shares, valuation of preference shares, valuation of debentures, and so forth and so on. Valuation of firms is another area where cost of capital is used. Cost of capital is applied as a discounting rate when valuing firms, making other decisions, financial decisions, such as lease or buy decisions, bond refinancing, and so forth and so on. Evaluation of management performance. Cost of capital is used as a yardstick to measure or evaluate the performance of the management. So Some of these are practical applications. Sometimes we like using the word relevance of the cost of capital. How relevant is the cost of capital? What are the uses of the cost of capital? Those are some of the main applications of this cost of capital. Now, the firm's cost of capital are of two forms. There's a weighted average cost of capital. There's what we refer to as the weighted marginal cost of capital. The firm's overall cost of capital are of two forms. There's a weighted average cost of capital, and there's what we refer to as the weighted marginal cost of capital. What is this weighted average cost of capital? Weighted average cost is an average cost of existing funds in the firm's capital structure. An average cost of existing. So the key word is existing funds in the firm's capital structure. When you look at the firm's capital structure, there could be existing funds like ordinary share capital, like reserves, like debenture capital, like preference share capital. So the average cost of funds which are existing in the firm's capital structure is what we call weighted average cost of capital. And you can see this is what I'm explaining. The existing funds, the firm's capital structure could include ordinary share capital, reserves, debenture capital, preference share capital. Now, it's a weighted average, just like the word says, it's a weighted average, it's a weighted mean. So we can determine WSEC using book value weights. We can determine using market value weights, but the most preferred weights are market value weights. And therefore, when establishing weighted average cost of capital, it's advisable to use market values as weights. We establish the market weighted average cost of capital. Okay, I think those are stories which I've shared there. I've already shared those stories. And if you check down here, I'm saying weighted average cost of capital can be determined as follows. KS, S over V plus KD, bracket 1 minus T times B over V plus KP, P over V, where KS is the cost of equity. The formulas which we're going to share for establishing the cost of equity. KD is pre-tax cost of debt, the before-tax cost of debt. Then KP is cost of preference share capital. T is corporation tax rate. S is the market value of ordinary shares, market price. Yeah, so when you look at the company's capital structure, you need to work out the market price of ordinary shares. B, market price of debentures. P, market price of preference shares. Now, I think I forgot to mention that V is the total market value of the firm. So if you take S plus B plus P, that one should be V. V. Yeah, V is the total market value of the firm. S plus B plus P, it should be V, the total market value of the firm. So if you take S over V, is the market value weight of ordinary shares. P over V is the market value weight of debt, and P over V is the market value weight of preference shares. So that is a small formula. You need to look for the cost of equity times WS. WS is what I've already explained up here, market value weight of equity. There's a small illustration that I've shared here. It says, Maridad Company is a firm operating in the textile industry. Firm's existing capital structure on 31st December 2019 was as follows. This is an existing capital structure. There is ordinary share capital, shillings 20 each, that is a par value, 60 million, reserves 20 million, 10% debentures, shillings 100 par value each, 40 million, 12% preference share capital, shillings 25 each, 20 million. The total is 1/4. This is what I was calling an existing capital structure. Over the last 5 years, firm's stream of dividend payment was as follows. 2015, 2016, 2017, 2018, and 2019. You can see dividends have grown. You can see quickly a dividend seem to have gone up. From the year 2015 to 2016 to 2017, 18, and 2019, dividends seem to have gone up. Current ordinary shares of the company are trading at security exchange at 3 each come dividend. There's a trick there. When your shares are quoted come dividend, you need to establish the price X dividend. Now you look at dividend for the current year, the year 2019. Dividend for the year 2019 is 3. So we need to remove it from that price to find the price X dividend. When a price is quoted, come dividend, you have to remove the dividend for the current year. From that, if you look at historical data, the most recent year is 2019, dividend is 3. So we shall work with 30. Existing 10% redeemable debentures are current trading at security exchange 115 come interest. Again, there's a trick. Now, these debentures, if you check here, 10% debenture of shillings 100 each. If you take 10% of 100, if you take 10% times 100, interest on a unit is 10. 10% of 100, that is 10 shillings. Now, come interest means interest is part of that price. So you remove 10. Price X interest is 115 minus 10. You compute the interest on that debenture, which is 10 shillings. So we shall work with 105. The existing 12% preference shares are currently trading at securities exchange 23 come dividend again. So if you look at existing preference shares in that capital structure, 12% of 25 should give you how much?
12% of 25.
Yeah, if you take 12% of 25, how much is a dividend on a share?
3.
3, yeah? Is it 3?
Yes.
Yeah, so that price is quoted 23. It is quoted 23 come dividend. You remove the dividend. You work with price X dividend. You work with the price X dividend. So down here, you can see the question says the existing 12% preference shares are trading at securities exchange at 23 come dividend. Come dividend means the price includes the dividend. So you work with price without the dividend. So you have seen up here, 12% of 25, that is 3. So 3 is inclusive, you remove it. So you work with 20, 23 minus 3, that is 20 shillings. Tax rate 30%, determine the weighted average cost of capital of the firm. So the first thing that you need to work out, are the market value weights. You need to start by looking for the market value weights of the existing items in the firm's capital structure. If you look at up here, you can see there are 4 elements existing: ordinary share capital, reserves, 10% debenture, and 12% preference share capital. All these are book values. What you are seeing here are book values, 60, 20, 40, and 20. I've told you that weighted average cost of capital should be worked out using market value weights. What you are seeing here, those are book values, 60, 20, 40, 20 are book values. We need to look for the market value. Like now, if you check that ordinary shares, if you take 60 million divided by 20, how many shares are in issue? If you take 60 million divided by 20, how many ordinary shares are in issue?
3 million.
3 million shares. And each ordinary share is selling at what price? We are told each ordinary share is trading at securities exchange for 33 come dividend. So we have removed the dividend of the year 2019 3. So that means each share is selling at 30. You don't work with price come dividend. Yeah, so that dividend of the year 2019 imetolewa, hiyo itakuwa 30. 30 shillings times 3 million what do you find? What is the market price of those shares? $60 million divided by 20, you said it's 3 million, eh? So those number of shares times 30, what do you find?
90
million.
90 million, eh? Can you see? This is the one I've worked out there. You can see, eh? 60 divided by 20, the number of shares is 3 million times 30, eh? That should be 90 million, eh? Okay, reserves. As for reserves, if you look at the other existing item is reserves. Reserves you leave out. When establishing weighted average cost of capital using market value weights, we leave out reserves. Whether they are revenue or they are capital reserves, that should be excluded. I think I've explained in that note. The 10% debentures, that existing item, if you take 40 million divided by par value of 100, how many units are there? If you take 40 million divided by 100, that should give you how many units?
400,000.
Each selling at what price? Each unit is selling at what price? If you look at this question, we are given 115 come interest, and we remove the interest. Was it 10 shillings?
105.
Yeah, so those number of units times 105 should give you how much?
42 million.
Yeah, you can see that's the one I've worked out there. Now you call them up, eh? Yeah, the figures are in thousand. That should be 42 million. The same thing applies to preference shares. You go here. If you take 20 million divided by 25, how many preference shares are in issue?
800,000.
Multiply by each share is selling at 20. Eh? Remove the dividend component of 3 shillings. We said that is 20. Eh? Yeah, so 20 divided by 25 times 20, that should be 16 million.
Yes.
So you can see how I arrived at those figures. Eh? So 90 million is what I was calling S, the market value of ordinary shares. B is the market value of debentures. P is the market value of preference shares. When you add those three, 90 plus 42 plus 16, you find 148 is V, total market value. So we need to find the market value weight. I've told you weighted average cost of capital should be worked out using market value weights. So if you take S divided by V, does it give you a market value weight of 0.61? Can you confirm? 90 divided by 148 is what?
0.61.
Sio mnaiona hapo, eh? 42 divided by 148. What do you get? 42 divided by 108.
$0.28.
You can see there, that's the weight of debt, market value, weight of debt, 16 million divided by 148. The market value weight. Yeah. So you have seen how I've arrived at that. So anytime you're looking for weighted average cost of capital, you have to do that working, find the market value weights. Now, we need to look for the cost of the 3 items. We need to look for the cost of ordinary share capital, the cost of 10% debenture capital, and the cost of the 12% preference share capital. Okay, now, if you look at this pattern of dividends that we have here, dividends, eh? You see the pattern of dividend payments? Look at the trend from the year 2015 to 2019. What has happened to the dividends?
They are increasing.
Yeah, dividends are increasing. Is it possible to know the rate at which dividends are increasing on average? From 2 to 2.3 is what percentage increase? From 2 to 2.3 is what percentage increase?
15.
15%. Have you said 2.3 minus 2 divided by 2 times 100?
Yes.
From 2.3 to 2.6 is what percentage increase? From 2.3 to 2.6 is what percentage increase? You take 2.6 minus 2.3 divided by 2.3 times 100. Hebu weka hiyo record mahali kando. So 2 to 2.3, you are saying 15% increase. Mimi sina calculator, so I cannot confirm you are telling me, but I want to believe in what you are giving me.
That's 26.
From 2 to 2.3, you find what percentage?
2 to 2.3, 15%.
Fine. 2.3 to 2.6 is what percentage increase?
13.
13. 2.6 to 2.8 is what percentage increase?
$7.7.
And again, from 2.8 to 3 is what percentage increase?
$7.1.
Now, how many percentages are those?
4.
Those are 4. When you add all of them and divide by 4, what do you find? What is the average? Add the 4 and divide by 4. What becomes the average dividend growth rate?
10.7.
10.7%. That is the rate at which dividends seem to be growing. You found 10.7. The rate at which dividends are growing on average per year. Okay, now the dividends are growing. You see, I've used another formula here. Can you confirm? I've used another formula. I have gone through a long way for you to see, but you can see I can find the growth rate by saying current dividend per share divided by the earliest, raise the power of 1 over n minus 1 times 100. If you look at this last historical history, the most recent dividend is 3. The earliest dividend is 2. So I've taken 3 divided by 2, raise the power of 1 over n, of course, 4. N is 4. If you check here, dividends have grown 4 times. 2 to 2.3, 2.3 to 2.4, mean 2.6, 2.2. Those are 4. The first time, the second, the third, the fourth. Dividends have grown 4 times. So if you take the most recent dividend in that pattern, which is the most recent dividend in that pattern, which is 3, divided by the earliest dividend, which is 2, that is 1.2, 1.5, minus 1. The most recent dividend less the earliest dividend, mean divided by the earliest dividend is 1.5 minus 1. If you take 1.5 minus 1, that should be 0.5. The fourth root of that, I think it should be 1.107 minus 1 times 100. You can see that The growth rate is the same. Eh? The one you worked out using the long method, I've used a small formula and the answer is the same. Eh? 10.7. Now, where dividends seem to be growing, then the cost of ordinary share capital should be worked out using that formula given up here. You take D naught, 1 in bracket 1 plus G divided by P naught plus G times 100. Eh? The cost of ordinary share capital. The cost of ordinary share capital. I can talk to nje kidogo. I write that formula properly so that you can get to see the formula properly. The formula for finding cost of ordinary share capital in a KS is equal to D naught 1 plus G over A naught plus G times 100. Eh? Inafaa kuwa namna hiyo. Eh? Now D naught is the most recent dividend. G hiyo ile tulikuwa natafuta. There's another form. The formula hiyo nimetumia ni hii basically. 3 is the most recent dividend over the earliest minus 1 times 100. Eh? EN 4. Dividends have grown 4 times. That's how we arrived at 10.7%. But we used an alternative in a long method. Eh? So D naught is the most recent dividend, which is 3. This is the price, X dividend, 330. Mnakumbuka? The price was 33 come dividend, remove 3 shillings. Now he ni growth rate 10.7%, 0.107 times 100. So cost of ordinary share capital is 3, the most recent dividend, 1 plus dividend growth rate 10%, 10.7 price, X dividend is 330 plus 0.107, the growth rate times 100. That shall give us the cost of ordinary share capital. You need to be careful. The price should be X dividend. The price should be X dividend. Where's to me a price come dividend hapo? The same thing applies to debenture, the cost of debenture and the cost of preference share capital. Yeah, so AS is equal to D naught, 1 plus G divided by P naught plus G times 100. Can you confirm? Is it 21.77? Is the cost of ordinary share capital 21.77%?
Yes.
Okay, secondly, the cost of 10% venture capital. So you need to appreciate the formula again for finding the cost of the venture capital, which are redeemable, irredeemable. After tax cost of the venture capital, KDT, is interest 1 minus T over market value of the debenture times 100. Hiyo ndio formula ya kutafuta the after tax cost of the venture capital, where I is interest. I is interest. T is corporation tax rate. 1 is a constant. This is the market price of each unit. If you look at this question, if you look at this question of ours up here, 10% is the rate of interest times 100. That should give you interest on a unit. 10% of 100, you close the bracket, 1 minus corporation tax, divided by the market price of each unit. We said 105 come interest minus 10. So the price X interest is 105. Should be 105. So if you look at this formula, you will say 10%, the rate of interest times par value. That is interest, that is the I. 1 minus corporation tax rate, 30%, price 105, X interest. Where's your price come interest, price X interest? Hii inakuwa ngapi sasa? 10, 0.7 divided by 105 times 100. What is the answer? Cost of the venture capital?
6.67.
Answer is 6.67%. Hiyo ni after tax cost of the venture capital. Now finally, the cost of preference share capital. The other existing item in the firm's capital structure is preference share capital. KP is equal to DP over MVP times 100. That's the formula for establishing the cost of preference share capital, where DP is dividend payable to preference shareholders. MVP is the market value or the market price of the preference shares. So you go to that capital structure again. You go to that capital structure up here. You can see the rate of dividend, 12% times 12 times 25, sorry. So dividend on a share is 12% of 25 divided by the market price. This was 23 come if we remove 3 shillings. Remember, we work with 20. The price, we work with the price X dividend. So 12%, the rate times 25, that is dividend on a share divided by 20. You don't work with price come dividend. 23 minus 3 times 100, that should equal to what?
15%.
10%. Sasa tukishapata hiyo yote, unaweza fanya the weighted average cost of capital. Those are the workings which I've done here. 6.7. Tunaona nimetoa that interest component, nimeonyesha hapo vile imetoka. Preference share capital is 23 minus 33. I think I should have said here 23 minus 3. Kutoa hiyo dividend component, ndio baki 20. The answer, did you find 10 or 15?
15.
Na huyu amepata 10 kutoka wapi? So weighted average cost of capital is KS, cost of ordinary share capital, times WS, KDT times WD, KP times WP. So we have done those workings. KS ndio tulipata. The weights, that's where we started from. 21.77 times 0.61. Now 6.7 here, we have already worked it out. The 6.7. Already we have adjusted for tax directly. We don't adjust again. Times the market value weight of debt plus cost of preference share capital times the market value weight. The answer is 16.8. Can you confirm? Weighted average cost of capital. Could you please confirm the answer is 16.8?
Correct.
What is the answer, ladies and gentlemen? 15.8%, eh?
Yes.
Is that correct?
Yes, it's correct.
Ukiangalia kwa past paper yenu kuna kitu mmeona? Tafuta weighted average cost of capital. Kuna kitu mmeona? Which is it? Fundamentals of finance. Hebu angalia past paper yenu.
May 2016.
May 2016. Question number?
2.
Hebu isome nisikie.
The existing capital structure of Morakaya Limited is given as follows. Ordinary share capital, shillings 100 per value, 40,000. Reserves, 15,000. 12% debentures, shillings 100 per value, 25,000. 10% preference share capital, shillings 20 per value, 20,000. A total of 100,000. Additional information, ordinary shares of Morakaya Limited are currently selling at shillings 10.80 each. The 12% debentures.
Hivyo hakuna ile trick ya kama dividend hakuna sasa. Sinaona hiyo sasa you multiply with that price direct, eh? Endelea.
The 12% debentures and 10% preference shares are currently selling at shillings 90 and shillings 30 respectively. The most recent ordinary dividend paid by the company is 2 shillings. This
2 shillings, eh?
expected
You
to
not,
grow.
eh?
Yes. Expected to grow at the rate of 10% each year.
Sasa tena tumepewa ile swali nyingine tumefanya, the rate was we had to look for the rate, eh? Sinaona hiyo rate tumepewa direct. The growth rate tumepewa, eh? Si ndio?
Yes.
Endelea.
The corporate tax rate is 30%. Required the weighted average cost of capital.
Hiyo mnaweza jaribu sasa. Na CPA swali yote ya weighted average cost of capital kwa karatasi yenu. CPA kuna ile mmeona?
Hiyo ni ya CPA.
Oh, hiyo ilikuwa ya CPA?
Yes.
Oh, na fundamentals of finance, are they here? My brothers doing fundamentals of finance, brothers and sisters. Are they in this class? Wale wanafanya fundamentals of finance?
Yeah.
Kwa past paper yenu kuna yote?
Sina past paper mimi.
Kwa question paper?
But November 2020.
Hebu isome na wewe hiyo swali. Isome nisikie.
I don't have the paper currently.
Nani tena ako hapa? Wa fundamentals. Tafadhali mfanye haraka, mimi nataka kurudi kulala. Si unajua you dealing na mgonjwa, si mnajua hivyo? Huyu mgonjwa kwa sababu anapenda sana, lazima ajikakamue. Wasaidia kidogo, eh?
Pole.
Unajua corona karibu nimalize. Ama nyinyi mnafikiria mnasikianga corona, eh? Mnaisikia, si ndio? Nyinyi mnaisikianga, eh? Hamjajua how it feels, eh?
Pole.
Mimi hata sasa hivi nasikia, hata I was testing my oxygen level, naona it's normal. This thing has put me down, my friends. I'm telling you. Nyinyi vaa mask zenu tafadhali. Vaa mask zenu mzuri, sanitize yourself, eh?
Yes.
Mimi ni mambo ya Mungu tu. Mambo ya Mungu hata pengine ningekuwa.
Yes.
Okay. But please take good care of yourselves, eh?
Yes.
Now, those doing fundamentals of finance, I wanted to confirm if there is anything in your passport you have seen.
Yes, we have.
November 2020, section 3.
Hebu isome na wewe, some loudly nisikie. Kama ni swali mnaweza manage.
Capital
isome.
structure.
Hebu isome kama kuna trick mahali niweza kuwasaidia.
Capital structure in which considered to be optimal is given equity 60%, debt 40. The firm is planning to raise additional.
No. Hiyo wacha, hiyo ni weighted marginal Hiyo ni marginal cost. Marginal cost jaongea. Hiyo wacha naye. Nitarudi kwa weighted marginal cost Additional funds is weighted marginal Angalia weighted average. Hiyo nasoma ni additional funds Weighted marginal cost of capital. Hiyo sijaongea mambo yake. Hiyo nitaongea nayo siku nyingine. Angalia kama kuna weighted average cost of capital computation. Hiyo weighted marginal. Hiyo swali ni ya weighted marginal Hiyo ni ya weighted marginal cost of capital Hiyo sijaongea, hiyo ndio mambo nitaongea nayo next time. I know there are a number of questions from weighted average cost of capital, those friends doing fundamentals of finance. Angalia tu kwa past paper yenu If there is any, you can also attempt Now, weighted marginal cost of capital, mnaiona ndio hiyo, whatever hiyo swali huyo jamaa alikuwa anasoma. Hii endelea kuisoma sasa, mimi sitaki kuongea mambo yake sasa. I've already supplied you some notes here, weighted marginal cost of capital. Wala muendelee kusoma soma, hata kuna illustration hapa I'll talk about it next time. Naona, swali kwa hapo, I've answered it. Sio mnaweza endelea kuangalia sasa. Si ndio?
Yeah. Yes.
Mniaje nilala sasa mimi?
Mwalimu, swali.
Yes.
Argue three cases for and three cases against the use of market value for various components of cost of capital in determining the WACC.
Now, cases for the
And
use of
against.
weighted marginal cost of capital.
No, weighted average.
Cases for the use of market values.
Okay.
The use of market values as weights. Hebu rudia hiyo swali tena.
Argue three cases for and three cases against the use of market value for various components of cost of capital in determining the weighted average cost of capital.
Yeah, the pros and cons of the use of market values. Yeah,
Yes.
market values reflect the true value of the security. You know, market value is market price. Okay?
Yes.
Market value, market price, market value of an ordinary share, market value of a debenture, market value of a preference share. It reflects the true value of the asset. That's one case for. Number two, market values are not historical. Book values are historical. Book values are historical. Market values are not. Okay?
Yes.
So you can argue, you can say, one, they reflect the correct value of security. They reflect what you'll actually realize from the sale of that asset in the marketplace. If you sell a share, you cannot sell it at book value. You'll sell it at market value. If a unit of a debenture, they cannot be sold at book value. Will be realized at market. So they reflect what you expect from the sale of that item in the marketplace. Secondly, they are not historical. Book values are historical. Market values are not historical. But on the demerit bit, you know, market value fluctuates from time to time. Book values don't change. Market values keep on changing from time to time. The price today, the price tomorrow, the price another day can keep on changing from time to time because it's affected by many factors. Market forces, company policy, the company performance, and so forth and so on. Okay. they are very volatile in terms of fluctuations. Eh?
Yes, thank you.
Oh yeah, sasa si mniache mimi tu. But I want you to please be
One
reading
question.
kindly. Can't you let me relax? Are you aware you are dealing with a patient? The final one. That's the final question. Eh? I don't want to take so many questions.
And Mwalimu, when you can you calculate the current weight, average cost, and expected? Is it the same as WACC, the current and expected?
Sorry, repeat your question again.
And when you're calculating the current weight, average cost, and the expected weight, average cost, is it? Can you calculate it the same as WACC?
Now, there is no difference between current and expected. Eh? The current weighted average cost of capital, it is the current weighted average cost of capital or current weighted marginal cost of capital. Eh? Are we together? You'll either be establishing the current weighted average cost of capital or the current weighted marginal cost of capital. The issue of expected, there's nothing like expected weighted average cost of capital. Okay?
There's this question, iko na hiyo.
Huh?
Kuna hiyo swali wameuliza expected weight, average cost of capital.
There's nothing like expected weighted average cost of capital, my friend. There's nothing like that. Eh? It is current, the firm's weighted average cost of capital or weighted marginal cost of capital. There's nothing like expected. There's nothing like expected weighted average cost of capital. What you can talk about is expected dividend payable. Expected dividend payable. Eh? But there's nothing like expected weighted average cost of capital.
It was November 2016, question 3, ATD.
Now, I don't care what examiner has written there.
Okay.
What I'm telling you, there's nothing like that. Eh?
Okay.
Yeah. So
Thank you.
or you don't want to believe, you don't believe I'm an authority in these things. Eh? I'm an authority in those things. Eh? So, and errors are there anyway.
Okay.
Errors can be made. So there's nothing like expected. It is weighted average cost of capital or weighted marginal cost of capital. Okay.
Okay, thank you. And sorry for the disturbance.
What I've talked about is computation of weighted average cost of capital. Eh? So next time I'll be taking you through weighted marginal cost of capital. Expected has to do with dividend. Expected dividend payable. Like now, if you say D naught 1 plus G, it's expected dividend payable. Eh? Okay? D naught 1 plus G in a year's time from now. So when someone says expected weighted average cost of capital, there's nothing like that. It is weighted average cost of capital of the firm now. Okay?
Okay.
So, unless there is another pressing issue, then I think we can stop at that. Continue reading on weighted marginal cost of capital. Eh? Now, that question you are saying, these people are asking expected. Can you read it? Can you read through? Let me understand the content of the question. Could even be having more errors. Eh? That fellow who raised that issue, can you read through the question? Can you read? I want to hear the content in the question. Is it possible to read through? Is it a long question?
It is a long question. But let me read it. Wema Ltd intends to expand its business operation on 31st October 2016. The company had the following existing and proposed capital structure to support expansion program. 1, the existing 9% debentures had a book value of 2 million and a market value of 18 million. A 12% preference share capital stands in the books at 4 million into brackets 20,000 shares and has a total market value of 5 million. There are 100,000 ordinary shares with current market price of 80 each. The dividend for the year ended 31st October 2016 is expected to be 2.2 shillings and 40 cents per share at a growth rate of 8% each year for the foreseeable future. The company plans to issue 50,000 ordinary shares at a market price of 80 shillings per share. The cost of flotation shares is estimated at 100,000. A 6-year loan of 4,500 is to be raised at an interest rate of 10% per annum. A cost of 150,000 will be incurred in raising this loan. Ignore taxation required. Current weighted average cost of capital for WEMA using market value. Expected weighted average cost of capital for WEMA after expansion program.
What is required by section?
Expected weight average cost of capital for WEMA after the expansion program.
Let me ask you, is that an ATD or a CPA question?
It's an ATD.
Now there's a problem. You know, this company is raising capital.
Okay.
See, that's weighted marginal cost of capital.
Yeah.
Nilisoma hiyo swali iko na shida bado, kwa sababu the question is about raising capital. So umeambiwa the company is considering expanding and raising capital using various ways.
Yeah.
So it cannot be weighted average cost of capital. The question should read, determine the weighted marginal cost of capital of the firm after the expansion program.
Okay.
Weighted marginal cost of capital. Hiyo sio weighted average cost. Sinaona hata confirms. Yeah. It should be weighted marginal cost of capital after expansion activity. Yeah?
Okay.
Anytime you are dealing with the new capital, you are raising new capital, that is marginal cost. But existing cost of existing funds is weighted average cost of capital. Existing. But when you start talking about new capital, raising additional capital, like now that is what the question is addressing. That is weighted marginal. Are we together?
Yes.
Your mambo ya weighted average cannot occur. It cannot occur. That is an error. Anyway, I'll talk about weighted marginal cost of capital and you should be able to answer that.
Okay.
Okay. Sasa wacha mimi nimalize mkutano. Was there anybody here? I saw somebody from Kitengela here. Priska, are you around? Priska. Did I see Priska here from Kitengela? Elizabeth from town campus in Nimemona. Koli To is from where? Loraka. Hey,
Town campus. Town campus.
From town campus.
Yes.
Otieno, Evans Otieno. Wacha niwaache sasa, bando zenu zimeisha. Angalia hiyo maswali ya weighted average cost of capital mfanye. Weighted average. Wacha marginal. Please check weighted average cost of capital and attempt a few questions. Sawa sawa.